So we're here today with Craig Beissel of AXIA Home Loans. I wanted to just talk briefly about the market, and as everyone knows from my previous videos, it is a low inventory market right now, so a seller's market. And there's some scuttlebutt out there about interest rates. So I wanted to talk with Craig a little bit about what's happening with interest rates and in association with the market, maybe dispel some myths that are out there right now.
Right. And hopefully I won't confuse anyone. I would maybe recommend folks maybe after they watch the video, if anything sounds confusing, you can always go out and Google some information. But I will do my best to kind of dumb some things down and kind of bring full circle with some conversations that I've had with quite a few clients over the last month with this crazy market, some things that are going on in the market with what the Fed has done, what the stock market has done, so on and so forth. So I will do my best to give it a high-level overview on what exactly drives mortgage interest rates, perhaps why mortgage rates go up and down, and really the Fed, and then bringing in kind of that myth, if you will, when the Fed announces that they're cutting interest rates, you know, folks automatically assume that's going to affect mortgage interest rates, and that's not necessarily the case. So the thing to keep in mind when it comes into to mortgage rates and what drives mortgage rates is the 10-year Treasury bond, as well as mortgage-backed securities. Okay, so when we see the market tank as it has, you know, up and down the last couple of weeks, when we see that stock market drop like we have, investors will tend to move their money into more secure investments. For example, the bonds and mortgage-backed securities are an investment that investors can invest in that are considered low risk. Okay. Now, the bond market, that 10-year Treasury bond, what we've seen happen is folks have been backing out of the market and buying into that bond market. And essentially what that does is it drives the prices of bonds up and it takes those yields down. Okay. Now that bond yield on that 10-year Treasury, we've seen drop below 1%, which is a record.
Yeah.
Okay, we've seen that drop below 1%, and we've seen those mortgage rates drop immensely because of that. And you can also tie in those mortgage-backed securities as well. We've seen those do some goofy things. So the long and end of it is what happens is you look at your 401k statement, your IRAs, your investments, and you're thinking, oh my goodness, what's going on?
Yeah, I'm trying not to look
Try not to.
Right now, right?
And what I've told clients to do is instead of printing off your investment statements, print off your recent mortgage statement, give me a call, and let's see what rates are doing. Maybe I can put a little bit of a smile on your face. They kind of work inversely. Mm-hmm. So that's the thing to kind of keep in mind, to keep it as simple as I can. That 10-year Treasury yield, we see that start to drop, you're going to see mortgage rates drop. Okay. Now, we couple in the fact that the Fed made an announcement a little while ago that they're dropping the federal funds rate by 0.5%. Okay. No direct correlation of having that control the mortgage rates. Now, could it have an indirect effect? Absolutely. When we see that federal funds rate possibly drop, people get excited. Maybe they start buying some more things. Maybe they'll invest back into the market. And we could actually see mortgage rates increase because of that.
Oh, okay.
Okay. So the thing to keep in mind is when that Fed makes that announcement of them dropping interest rates, they're controlling such the prime rate. They're controlling, essentially you're going to see your credit card rates possibly drop. Yeah. Short-term interest rates, for example, car loans, things of that nature are going to drop. Okay. It has no direct effect on mortgage rates. So if you can take anything away from this conversation, it's just because the Fed drops the interest rates does not automatically mean that mortgage rates are going to drop. In fact, I've seen it before where the Fed has cut interest rates and mortgage rates actually went up because of what went on in the market. Okay. I would say if you're in the market to buy, get with a loan officer right now, get that pre-approval, get that things buttoned up because as you know, when something hits the market, you got to have your numbers ready to go, make that offer, make that solid offer, so that you're ready to go. And hopefully, if you're in the market to buy, you can cash in on these low interest rates right now to purchase that house. It may increase some of your buying power, and you may be pleasantly surprised.
Maybe one of the things that's out there that people are worried about is I haven't been in my house long enough. I've only been in my house for a year or 2 years. Are there restrictions? Is that going to jab them a little bit if they refinance too fast?
Great question. That is, and the reality is that if you're only into it for a year and you're on a 30-year, we maybe restarted a 30-year, interest rates are probably 1% lower than what they were a year ago. Some of my clients that are refinancing right now may have refinanced with me a year ago, may have purchased a house a year ago. And we look at the numbers, we sit down and we determine, hey, does this make sense? And if it makes sense, we pull the trigger. The short answer to your question, you could be in your house for a month and still refinance if you really wanted to.
Wow,
Yeah.
really did not know that.
Yep.
Okay. So Craig, if someone wanted to call you, what number would
Best
you like?
number to call me is 651-253-9002. Call me anytime.